Hi folks, it's Adrian Zlunchuk, CMT Chart and Market Ignition CryptoBirb, and this is a video webinar for Friday. Welcome to the Friday webinar. And it's been quite an interesting week overall. We are in July. That statistically is the best month of the entire weakest quarter of quarter three, typically where the volume of transactions kind of like goes downhill, where the engagement across the investors, among the investors, actually just also, falls down, as well as it translates to the markets, typically going more horizontal or downwards, right? We are locking this positive buying caution, this buying pressure from the investors that ultimately translates to the flatness in the market. So there is little interest among traders to trade it, and yet there are a lot of interesting things happening behind the scenes because ultimately we just got the CPI data freshly, and it seems that there are more and more chances, slowly but surely, towards a potential interest rate pivot from the Fed and FOMC. So let's take a look at the charts and review what we have in store right now, starting off basically from what we have, right here. This is the latest piece of information that I had about the macro information that I base on macro finance reports, the National Retail Federation, NRF, for the monthly kind of like a review of the data of the reports that I love reading, actually. And this is a summary of that. And ultimately, with falling inflation, that is the case, interest rate cuts ultimately can turbocharge the big bull, can add ultimate final kind of like a final fuel to start to fire off the rallies, as they're intended to happen in quarter four later this year. And that markets typically lead 6 to 9 months ahead of the economic cycle, right? So whatever we see in the markets, it typically translates into economic activity 6 to 9 months later. However, if we are too early, it means that we can actually put ourselves and fall into a trap of the seasonal weakness in quarter three. So there are several macro finance numbers to pay attention to. Ultimately, employment costs, right? Unemployment grew by 272,000 jobs in May. And that's the data from May. It's do remember that some of the data, unless if not most of the data, are basically recalibrated and rechecked, double checked. There are often some errors, to the previous releases for the GDP ratings and so on. So it's a pending ongoing issue. Following 165,000 in April, average monthly gains ultimately through May were 248. So it's almost 250, just below 251. That is 2023 average. Ultimately, 3-month moving average, as the red curve indicates, of the monthly non-farm payrolls. They do increase locally. Ultimately, in May, there is a positive spike in the payrolls at all, right? Decent boost, 272 out of 165. That's a decent boost. PCE, that is the dominant kind of like a indicator for the FOMC and for the Fed to make up decisions about the inflation. That's what it typically goes with here. The PCE price index shows personal spending, right? Consumption expenditures 2.6% year over year. Inflation in May down from 2.7% in April. Service sectors remain still very high. For the services, 3.9%. Like I said, 2.6% for the average itself, while we observe minus 0.1% on the goods, which is decently positive thing. Overall, the down curving shift is present and visible since May 2022 ultimately. Now, goods and services, for the spending in May, PCE, like I said, rose 0.2% month over month and 5.1% year over year ultimately, indicating strong but volatile consumer spending, right? That's a personal consumption right there. GDP and unemployment, 1.3% almost and only, right? In quarter one 2024, those numbers were revised. 1.3% GDP growth is not much, right? This is right before the red bar that you see on the bottom right of this chart. Ultimately, the real GDP and the unemployment rate continues to climb slightly towards the 4%, as they're estimated later this to be revised also for quarter two, down from 3.4% in quarter four last year, right? That's a significant drawdown, actually. 3.4% down to 1.3%, right? That's a very heavy drop. The labor market still remains resilient, even though the unemployment is rising, however, still low. The household wealth, that's something interesting. It hit 147, almost 150 trillion in quarter one, with 8.8% boost year over year, right? That's an all-time high for the household net worth. Ultimately, what it tells us is that actually households hold more money. They do hold more money, ultimately driven by still, even though falling, still high inflation, elevated inflation. The spending conditions up there, like I said, the consumer's sentiment is falling lately, and it's actually reached, per literally what it says right there, to 7-month low in June. Right, this is also the reason why the household wealth not only aggregates there, it's also the just domestic kind of like disposable income that is there. At times it's put aside, for the savings instead of just being spent. That has a toll on the economy, right? As we tend to think more conservatively about the future if we choose to not spend that money, instead just try to kind of like save it for later. And the job openings ultimately at the lowest point since 2021, still above the pre-pandemic levels. And if we were to put it in the key conclusions, ultimately, is that the financial markets not only do precede the economic changes by 6 to 9 months, which is important to observe, both the technical data as well as the macrofinance data that is kind of like at times lagging, except, well, there are leading indicators as well, like the CPI itself, for instance, on the, well, not so much on the CPI, but there, for instance, on the interest rates, right? On the interest rate curve, the yield curve, is something that often precedes big important economic turns such as the recession, right? And we do maintain the inverted yield curve situation, where the longer maturities actually pay off less than the shorter term maturities. That is quite unlike the common sense. Still, so the Fed's cautious rate policies does reflect the ongoing inflation concerns. Even though inflation is dropping, it's still on the watch list, and it translates to slower GDP growth, the household net worth records, more saving, less spending, the sentiment falling, and ultimately this is alongside the resilient job market, right? This is something to consider. And if we go to this tab instead, this is latest CPI June data as well, right? As we actually had a little bit more positive, impressive change take, if you will. Here we are looking at the 3.0% year over year inflation, right? It just fell versus the last month by 0.1%. This is the blue curve we are ultimately talking about, right? All items are basically at 3.0%. So that's a decent take. Gasoline 3.8% dropped right there. Food rose 0.2%. Energy fell 2% in June, 1.1% of a year. And that's excluding food and energy. Ultimately, the CPI, the Consumer Production Index, Consumer Price Index, I'm sorry, rose 0.1% monthly, 3.3% yearly. Okay, those are very interesting numbers because it all translates also to the overall expectations, from the market itself, from the investors, as taken from the after this reading on the CPI, that 93.3% of the people, that translates to the frequencies, to the probability ultimately of the investors, they do expect the rate hike pause, another rate hike pause in 19 days on the 31st of July, while 6.7% only, they do expect actual rate cut for the first time. So there is ultimately not much expectation towards this very next FOMC coming later this month, end of the month, to be the pivotal month. Although there are some good, interesting things lining up ultimately for the Fed. And like I said, falling inflation ultimately is something that may encourage the Fed to drop the interest rates, and that could supercharge the actual big bull that is lasting in the markets. And how do I know the big bull is in the markets? Not only because Bitcoin actually grew since the end of 2022, from 19,500 all the way to 74,000. That's not something that happens in the bull market, right? Ultimately, we're talking about an incredible growth right there. Incredible growth taken basically from 15,500 to 74,000 takes us somewhere between 350 and 4,000 and 400% of the growth right there. That's a very interesting push, right? That's a very decent push. The moving averages ultimately are, especially the longer ones, the less sensitive ones, are still ramping up. The recent slowdown actually with the breakout below $56,000 right there towards 53, even though you see a lot of those kind of like long lower candlesticks, the sticks themselves, right, the shadows, the candle shadows, they are interestingly kind of like, again, right there, if you see a candlestick type of a bullish hammer, for instance, right, it has a long tail, long candlestick, long shadow at the very bottom, and the body is accumulated for the close and opening price is accumulated somehow in the upper range, right? This is a typical kind of like a bullish formation as long as it happens after a series of falls, which is exactly what happens here. And we tend to observe a couple of those long bottom weeks ultimately, and this means that there is a buying interest, right? Because it means that the prices had to drop towards those levels and they had to be rebought ultimately at these levels, right? So even though there is some decent local pullback, if you will, approach, right, the local resistance towards which Bitcoin may ultimately pull back at one point is about $564,000. That's where Bitcoin may park for a mean reversion if we are to expect any short-term upward pullback, as some sort of like a briefer, recovery, the market taking a breath or break. Ultimately, this is what may happen, right? Because we've been in a complete sell-off mode ever since since a month ago, since the June 5th, where we actually nuked their 72K, just started falling lower. This is what took us ultimately, like I said, to the 53,500s. And this diminished a lot of the bullish sentiment. This diminished a lot of sentiment at all among investors, actually turning into fear. Turning from greed into fear in a matter of a month is a complete 180-degree rotation in the market in terms of the sentiment, and that's something that that tells us a lot, right? So the trends slightly, the more sensitive trend, this one is the 200-day bear beacon approach, and is a proprietary indicator. It's more sensitive than most recent data. It's a little bit like an exponential moving average. It's different, it's better, it's more sensitive, and it's more relevant. However, you can compare that to that much more than the simple moving average that is based on the arithmetic average. Ultimately, if I, like I say, the 63,564,000 seems to be the region of interest if we are to pull back higher. However, the longer time, the more time we spend below the actual broken support at 56,000, the bigger the chances are that after this local pullback that we may see ultimately with the bargain hunters, stepping in, this may happen to take a little bit of a medium-term toll and even push us towards the low 50s once again. And that is not something that is, I should say, ruled out of the cards. We shouldn't ignore this support, this chance, this threat, this danger, because the breadth conditions are extremely low. Only 5 or 4% of the crypto coins are above their 200-day moving averages. That's a very significant pullback from almost 70% just 3-4 months ago, right? So 70% of the coins were above 200-day moving averages in the long-term bullish situation setup above the long-term trends that were rising. And right now it's only 3, 4, 5% of the coins. That's not positive. It means that anything that is rising is basically in the 5% out of 100% that should be rising, right? Those are the lone riders. Those are the lone kind of like, investors, outliers. They shouldn't be taken as indication of the strength of the market. It's rather some local strength and an overall weakness. So I wouldn't be surprised if there is a capital withdrawal, just like I said, that we continue to have this continued local diminishing type of price action tendency, right? There is not much steam in the market. There's not much fuel And here we are, just struggling to get back above 57, maybe $60,000. And that's also seen in the RSI. We continue to spend most of the time. In the RSI side, basically right here, below the 50-day trend. Right, this 50-day trend is basically what we're looking at right here. With this black curve, it's a 50-day smoothed average, right, out of the RSI, and this tells us that the 50-day average is the medium-term momentum is at 44. It's still falling. It has falling serious, just like it said since March, since April, and we tend to spend most of the time, right? Most of the time we tend to spend below that, which tells me that the bulls are suppressed, that the bears are on the winning side right here, on the winning streak, even though there is not much of the extreme bullish bearish tendency, I should say, right? Because the momentum is weak. If there is weak momentum, the bears typically take a lead over the bulls. However, most of the time we do observe Bitcoin moving sideways, right? It moves sideways. It's not something that I would call a very aggressive bear market trend or anything like that. Besides, the 200-day moving average, the simple moving average, that is less sensitive to the overall recent data, we are moving higher and higher. It's climbing higher. And if it is climbing higher, this ultimately may mean, right? This ultimately may mean that, there's not much to worry, even though we might see just a little bit of a pullback. It tells me that it's on the long-term side, the bull market is there. It cannot be ignored. It cannot be denied. Same way I informed about this breakout last year too, in January, February, when Bitcoin was breaking $20,000 right there. Quite a journey to 74K. Like I said, a little bit chop. Some people can refer to it as the ultimate sequence of lower highs and lower lows, right? Even though it's not very aggressive, I would much more dare call this some sideways type of a setup, some deeper retracements. However, they keep coming back, right? If there is a lot of chaos, a lot of noise, you're going to see a lot of those trap breakouts, those false breakouts. And if that happens a lot, that's more of a sideways tendency than it is for the falling. However, if we continue to make lower highs and lower lows, that's a corrective tide in a bull market, right? That's a corrective bearish tide in the bull market. So definitely medium term or even long term, anything above 3 months in crypto is light years. Basically, is a decade in traditional finance. So 3 months, anything above 3 months is considered long term. Anything between 3 weeks and 3 months is considered medium term. And what we're looking at here right now is, like I said, because a correction since March that's been taken 4 months already, and we are there squeezed from above by the 200-day moving average. Watch may be posing a little bit of a resistance at $59,000. Something to consider. I wouldn't turn myself into any sort of like a bear. Definitely, as long as the bull market keeps climbing, as long as the bull market trend at SMA 200 keeps climbing, because that's what the bull market means. If the moment that this 200-day curve starts curving down, basically that would be quite a big warning and a signal, the red flag alert for the bulls to ultimately quit. Just maybe. Until that happens, I do fancy strong Q4 and strong half year, the first half of the next year. For my system, there is not much recently going on, to be honest, right? Which is interesting, because ever since I got the exit signal where the bear signal kind of like appeared, right where the bear breakout came up, with the breakout at 67,600, ever since I was staying flat on my active trading side, right? So for a month, I've been out of the position. The previous positions got stopped, and they got stopped at $67,000, just 67,600, just like it was here, right, with this very breakout signal to the downside. And here I am remaining in the protective side and cash side on the portfolio, on the active trading portfolio. All right, so here we are. If we are to take a look also at the ETF data, let's take a quick look at the ETF data. So what do we see? 11th of July, it's from yesterday, 323, almost and a half billion of cumulative Bitcoin ETF volumes for the spot, with the market share at 89%, almost 89.2% of the spot, which means that 89% of the ETF loads volumes is focused on the spot, on the buy and hold. Only 10%, 11% is focused on some gambling and speculation side. The long-term boosts are there. Now, with the net flows at 147 million from the 10th of July, not bad at all. The 17.72 billion ETF AUM for the IBIT for BlackRock iShares, right there with Grayscale GBDC spot ETF for 15.63 billion with the Fidelity right there behind as the third player, 10.5 billion under assets under management. So those are the facts, those are the numbers. The engagement is there, that the funds are not quitting. They're actually accumulating just a couple of days, right? The fund inflows are positive just a couple of days lately. So they seem to be attracted and accumulated. They seem to be accumulating with the hands of the buyers. So if we are quickly to see what's happening on the other markets, right there, here we are. Shout out to our partners at Soil, because Soil Farm, they're incredible partners, institutional providers right there for the yield generation, for the traditional TradFi or WAs, tokenized assets. Incredible partners, incredible people, great project. And ultimately that can be seen as well in the spectacular growth of the token itself from 0.4 upper basically dollars, from 4 cents all the way to $420 almost, right? That's quite a significant growth for the peak marked where the market's parked, 74,000 for Bitcoin and so on. Ever since it's been a gradual decline, the BPRO flashed the bearish tendency signal actually right there in the beginning of April, and it's remained bearish until now. It's remaining bearish until now, right? There hasn't been any invalidation. The DEF cross, if you will, that 50-day average crossing below the 200-day moving average, which is this curve, right? It's a little bit more flat. The 50-day curve is dropping. That's a DEF cross. It's a bearish confirmation. However, this bearish confirmation, especially when taken arithmetically, the arithmetical averages are far less sensitive. So what we can tell is that the bearish tendency remains, just like it does for, like I say, 95% of the coins. So here is not an exception. And even though we parked significant drawdown so far, right? Very significant drawdown. We tend to observe this local interest, perhaps where we saw the strength before, right? The strength before, or actually the weakness before at $1, just maybe the area for anywhere between 0.5 and $1, was the previous consolidation area. This is typically where some polarity change principle may come into work. Like I said, I have no idea about the future. I can only read the charts. However, I wouldn't be surprised if we search for some floor anywhere over here in the previous area of interest that was between 0.5 and $1. That may actually bring a lot of bargain hunters for this very valuable project, because ultimately, how many times in a year, how many days in a year do you see as powerful projects being down 80%? Something to consider ultimately, as well as for AZERO, right, who are also our partners. Quick shout out to them. They're doing incredible work, incredible ecosystem for a lot of very talented projects as well. We're proud partners right there. Even though technically, like I said, it also subscribes to this overall group of 95% of the coins being below the 200-day moving average, which is clearly to be seen over here. 200-day moving averages, this light gray curve that is also falling right there. The BPRO remains bearish ever since the end of March as well, so this is no different. It's very similar to Soil. That's a 3-day chart, by the way. That's a 3-day chart, so each and every single bar represents 3 days of price action. And we do observe this continued fall, right? With the key resistance at 0.66, 0.67, 67 cents. And until it gets broken, we tend to observe this continued bearish tendency, right? That's what it seems. For Credefi, for Credi Token, who are also our partners, quick shout out to their team. Ultimately, tokenized or WAs is something that is very hot topic. Credefi has been doing somewhat nice as well. Decent bottom put in around that breakthrough of 2022, 2023, right there. Significant growth ever since, because ultimately from the lows to the peaks, we were talking about the growth of 70x almost, 70x, right? That's a very powerful trip right there. 3-day chart as well. Daily RSI, it's right there, consolidating, hovering right around the 50-day momentum. So the 50-day momentum and the short-term momentum are sort of like on average on par or at par. And well, what we can say is that the 200-day moving average is right there. So we are hovering and being glued right towards this 200-day moving average. And historically, like I said, in the times of the dips and the times of the corrections, any valuable assets that have this rising tendency from the 200-day moving averages, when you see them dropping below now this moving average, they tend to be decent buying opportunities in the hindsight, right? So you want to catch those dips ultimately that are happening in the context, in the environment of a rising 200-day moving average, because ultimately this tells you that this market moves up on average. And if it does so, then just maybe it's worth considering getting on the dip somewhere over there. Like I said, any of our partnerships I truly value. Chart-wise, investment-wise, I do always recommend so you take it with grain of salt. Anything that I say, you always do your own research. Check whatever fits your trading style, right? That's not something given or guaranteed at any time. And if we move to Ethereum, right, just in case anyone missed it, I actually made my long-term purchase. I added 25K of Ethereum, worth of Ethereum, right at, it was, what was it? 3062. Right, so slightly up on that. However, same principle, rising 200-day moving average whenever. That's something that I did as well for Bitcoin, another 25K batch. Now for long term, right? Bitcoin dropping, any coin dropping that is valuable, that is rising in this 200-day moving average context. This means this is a confirmed bull market. And if this is a confirmed bull market, then you might want to scoop something below the average, because if the market just drops below the average and it's still rising, then it means that, ultimately it's underpriced. And if it's underpriced, it may go up in value. And ultimately, Solana, right? Such a hot topic. Ultimately, we're defending the lows right there at around $120 with the peak at 210. That's a significant drawdown as well, right? Like any other coin. Like I said, it's down 44%. Maybe it's outperforming a couple of other altcoins. However, we do observe there's some sort of like a squeezed version of a descending triangle, right? Descending triangle, lower highs and flat lows, ultimately something to consider. If that happens, and if that extends without the breakout, that may encourage some sellers to step in and perhaps pull us lower towards the weakest parts of the month of the year, towards August and September. I have no idea about that. If it does so, this Solana will likely become a good buying opportunity. Until then, we're moving in this sideways descending type of a conjunction pattern, right, where we just bounce on a fixed floor and just continue to be suppressed from the upside by the walls of the sell orders, ultimately that traders feel that they're feeling uncertain about the future, hence taking profits and just getting out slowly, step by step. So ultimately, everybody, if this is something worth considering for you, right? We have some, great opportunities coming for everybody ultimately, because we, for some time, have been in the strategic partnership with the Nomad Fulcrum. Huge shout out to them. They are our partners as well, strategic partners. And with Nomad Fulcrum, they are actually Swiss-based hedge fund, right? They're a tokenized Swiss-based hedge fund. And if I am right there to give you a little bit of a better understanding, let me just capture this screen. Here we are. Then we opened a prop desk. We opened an inverse prop desk where we don't charge you anything. It's completely free. You would trade on demo accounts for 90 days. And if reliable, if fulfilling assigned tasks given and defined by the hedge fund itself, you may actually get a contract, the salary, profit share from real money, with real money from the hedge fund. Something to consider: no costs and trading demo, paper money, which means no costs, no risk, real money, profit share, real salary. Being part of the Birbness team ultimately is something that gives you the career access, something to consider. And if you feel like it, feel free to go ahead to the birbness.com/inverse prop desk or IPD, and that's where we are. Otherwise, you can go ahead and search it under services, the prop desk, inverse prop desk. Here we are, and we're going to help you basically with the training program on our inverse prop desk, and you can become a profitable full-time trader in 90 days without costs, mastering all the other markets. The seats are limited. We only take in 10 most qualified traders every month, and who knows, maybe it's going to be you. Something to consider before we wrap the show. I do want to thank you for watching. If you liked and enjoyed this video, make sure you hit the subscribe button, smash the notification bells on to stay tuned anytime we put out a new content. If you're watching that on X, so be it as well. Huge shout out to you. Much love to everybody. We love you all. This has been your host, CMT Charter Market Technician, CryptoBirb. God bless you all. See you around, and bye-bye.